Thank you for joining me today, everyone. Dan Miller, Miller Financial Group. Today is March 24th. And what I'd like to do today is I wanted to do a short webinar here for you about managing through the coronavirus crisis. There's been a lot of talk in the news, and of course, we're all living it. We're all having to experience. So I have a presentation put together here that I want to walk through. So right now, I'm going to boot that up for you. And so bear with me just a second. I'm going to share my screen with you. And we will. All right, again, Dan Miller, Miller Financial Group. Today, I wanted to walk you through a short webinar on managing through the coronavirus crisis. As we know, we're all being asked to either shelter in place or keep our social distancing and all of the effects and things that have happened. So these are some interesting times. We know the Dow Jones has been fluctuating 3,000 points in a day. Sometimes the circuit breakers have been tripped 2 times in a week. Oil hit an 18-year low. You know, there's panic investors that are looking for liquidity, and some of them are selling their long-term government bonds, gold and municipal bonds, and the market has decreased 30% from its February peak. So today I want to cover 3 main talking points. I want to explain what's happening. I'd like to visit a little bit about what marks the end of the bull market, at least for now, and why the coronavirus is different from some of the other viruses. And I also want to talk about that, you know, this is a bad situation, but does it compare to 2008? This has caused a lot of volatility with the single biggest market movement days, both up and down in the past decade, have all happened here in March 2020. It's been one of the quickest shifts to a bear market ever, and the swift drawdown was particularly due to a lack of information, as the economic underpinnings, you know, going into this were relatively strong. And also, folks, I want to talk about the path moving forward. You know, the economy was fundamentally sound before this crisis occurred, you know, and that does provide hope for us going forward. You know, no one can make a credible economic forecast right now, which is one of the reasons that the drawdown was so swift and the volatility so extreme. So this is what's going to be the basis for our webinar. I'll try to walk through it pretty quick, and hopefully there'll be a lot of good information here for you. Before we get started, some disclosures here. The views stated in this presentation are not necessarily the opinion of Daniel S. Miller, CFP, or Miller Financial Group. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, this accuracy or completeness cannot be guaranteed. Past performance, of course, does not guarantee future results. And investors also cannot invest directly in indexes. The performance of any index indicated is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. All right, so what is happening? All right, so we're going to start in with that. What is happening? All right. Well, what do we know about COVID-19? Well, according to the Center for Disease Control, you know, the novel coronavirus, or COVID-19, has been detected in 190 nations and territories, and the number of cases grows every day. The World Health Organization has declared it a pandemic, as we all know, and at this time, there is no vaccine to protect against COVID-19, and there are no medications approved to treat it. Now, we've all heard the rumors that some of those things are coming, and that there are some experimental things in the pipeline that are being utilized right now. But as we know, there is no medications approved to treat it at this time. Well, because of that, you know, the known unknowns is creating market volatility and therefore losses. You know, it's really difficult to predict how this virus is going to fare over the next 7 months, as there are multiple unknowns out there. And in regard to that, that is a big part why we are seeing this volatility that we've seen. You know, remember, the current market distress is mostly directed to these unknowns. You know, it's unknown how the virus is going to respond to increased temperatures whenever it does start to warm up throughout the entire country. whether people who have survived the virus can contract it a second time. And we don't know, one of the unknowns is when a vaccine will be developed to protect against the virus. So remember that the current market distress is mostly directed related to the uncertainty surrounding COVID-19 and not underlying economic weakness. Because like I stated before, you know, as we know, going into this scenario, the market was pretty strong. I want to look at a little more information here. There was some information put out that by the Imperial College of London that does some computer simulations on outbreaks. And the bottom line, that is, in order to keep from overwhelming our healthcare system here in the United States with severe cases, the government will have to place some very tight controls on transmission through social distancing, which we're doing right now. And those controls are going to be so tight that they will be economically and socially, you know, very damaging, and we're beginning to see some of that. The researchers predicted that if the United States did absolutely nothing and did not take these steps to mitigate the spread of coronavirus, the models had shown that about 2.2 million people could potentially die in the US. Now, modest restrictions on social activity by their models says that it cuts deaths in half and reduced peak healthcare demand by over 2/3. So again, all of you heard out, you know, flatten the curve. We want to keep below that curve of what our healthcare system can handle. So under this model, even if all patients were treated, the US would potentially still see up to 1 million deaths. You know, so it's likely such measures, most notably large-scale social distancing, you know, that we're doing right now, will be needed to be in place for some length of time. We don't know how long, perhaps until a vaccine becomes available. And again, this is according to the Imperial College of London. So those are the known unknowns that has created a lot of volatility here in our market. All right, so part two here is, this is bad, we know that, but how does it compare to 2008? Well, first of all, I want to look at the VIX. The VIX is at a record high. And what the VIX is the CBO Volatility Index that measures the 30-day implied volatility of the S&P 500 index based on out-of-the-money option prices. All right, so if you look at our chart here, you'll see that back in 2008 and 2009, we surged up to a level of 80.86. And currently we are at a level that has surged up to 82.89. All right, and that was as of, I believe, the 16th of March. And this fear gauge was very, very close to that, like I said, in 08, but not to the level that we are right now. Now, one of the things to point out is part of this volatility is being caused by program trading. And what is meant by that is there are a lot of mechanisms in the trading industry now that once something falls or once a certain amount of volatility kicks in, that it trips and there's other selling that goes on. So again, this type of behavior has happened before, but that is leading to this volatility. The 2000 financial crisis, or 2008 financial crisis, was a period of great uncertainty where both the short and long-term behavior of the market and the economy were complete mysteries and required remedial measures for years afterwards. The worst case scenario indicates that the current crisis does have some of the same challenges, but one of the key things to point out is we are going into this crisis in a much better financial condition in January and February of this year. All right, well, one of the things we do know also is that uncertainty yields headline risk, which then yields market volatility. And one of the things that we're seeing is that investors are largely responding to headlines, which causes significant market volatility as each day brings different news from the day before. You know, if you look at the graph over here on the right, this graph shows that the market has been experiencing significant gains and losses with seemingly no rhyme or reason. if you look here at January and February, we had a fairly strong market. We know that we were going along there pretty good. There was a little bit of volatility. But then as you see, as we got into the end of February and the first part of March, and the information got out about what was happening in China, that they were building the temporary hospitals, they were worried about the coronavirus risk, that the volatility started to kick in. Well, during this time, we have seen some of the largest moves that we've ever seen. And this graph shows that the market has been experiencing significant gains and losses, again, with seemingly no rhyme or reason. On March 16th of 2020, the Dow recorded its worst one-day point drop in history, 2,997 points, and its worst performance on a percentage basis since October 19th of 1987. And then in the same week, in the same week, later on, that same week, on Friday, we saw the Dow have the largest point gain ever, rising 9.3% on Friday of the same week, and you'll see that illustrated right here. And the other thing that I might point out, and again, this is from the fact set, the market has been up or down greater than 4% for 6 days in mid-March. And the last record for that type of activity occurred clear back in November of 1929. So we have seen unprecedented daily moves. And again, the majority of that has been based on uncertainty and fear. So that brings us to the next point. When will extreme market volatility end? Well, we believe that market volatility will continue until there is a clear and present path that's moving forward from the present crisis. And what would it take to do that? The path would likely take the form of one of three things, where we have a sustained decrease in cases, a sustained decrease in deaths throughout the world, and especially here in the US, and the creation of an effective and trusted vaccine. Now, can we absolutely predict that with any certainty? No. But until then, we feel that you have to be prepared for anything. All right. Now, some of the other things that are being looked at as well is that what is happening, again, throughout the other parts of the world. We're looking toward China as a leading indicator regarding recoveries and the economic rebound. In other words, it started there. The path that it takes will probably somewhat dictate. Now, of course, our response wasn't the same as theirs, but our response was more aggressive, but we are looking at them as somewhat of a leading market indicator. All right. So a lot of the questions that we're getting is the current market situation comparable to the 2008 financial crisis? We all know that in some instances, it feels like it. All right, it does feel like it. That's getting to be, 12, 11 or 12 years ago now. But for a lot of us, we can still remember that. All right, well, the chart that I'm showing here, this chart shows that the financial stress indicator is the highest that it has been since the 2008 crisis. You can see that as dictated right here. Here's where we are. This was as of March 13th of 2008. The current effects on the market are less severe than the effects of the 2008 crisis. I know that may not feel like it right now because we're living in the middle of it, but it is not as bad on our market as it was in 2008. As of March 18th, stocks have fallen around 30% from their peak in February of this year. That's compared with a 59% peak to bottom during the financial crisis in 08 and 09. Now, it's too soon to say what the magnitude and the duration of this crisis will look like, but to date, you can see that we have not had near the type of magnitude of financial stress in the United States that we had back in 2008 and 2009. All right, well, COVID-19 hurts businesses and a technical recession is very likely. As of mid-March, the coronavirus has begun to affect virtually all businesses. We all know that. We're living it right now. Currently, hospitality is being hit the hardest as people cancel reservations, and we're seeing cities shut down restaurants, bars, and public events. According to the Wall Street Journal, in some restaurant, traffic is down as much as 80%. And of course, we know a lot of those areas have been closed to maybe only takeout only. In addition, while larger businesses are able to offer paid leave or rely on profit margins, small businesses do not have this capability due to their thinner margins and often smaller cash reserves. So it remains to be seen what relief is going to be offered. Now, we do know that some of the states are beginning to come up with some programs, and the Small Business Administration is as well. But how much that will be available is still yet to be seen. It should also be noted that while working from home does seem like an easy fix solution to prevent contracting the virus in the workplace, according to the Bureau of Labor Statistics, only 28% of the workers are actually able to effectively work from home. And so, it's not as easy as saying we're just going to all work from home, because you think about a lot of the industries, they're not able to do that. All right. So, healthcare, they've got to be on site. They got to do those things. Jobless claims have hit a 2-year high on March 19th at 281,000. Indications are that jobless claims could potentially grow to an unprecedented amount above that if things do not change. And that's especially if the situation would drag on some time. To put that into context, jobless claims reached about 600,000 in the 08 and 09 crisis. So if margins are too thin to pay workers to stay home, and not all workers can work from home, and if businesses is generally decreasing, what are business owners thinking? Well, the results are exactly what one would expect in a time of crisis. When surveyed, twice as many business owners throughout the economy would weaken within the year, and even over the past week, we've seen business owners' confidence in the economy decrease. On March 2nd, according to the Goldman Sachs Global Investment Research, 25% of business owners believe that the economy had worsened from a year ago, and by March 9th, that number had climbed to 38%. So we are seeing a real hit on our businesses, and how far that's going to go and how deep is yet to be seen. All right, so is there any good news? Well, data predicts that there could potentially be positive quarters for Q3 and quarter three and quarter four. It's hopeful that any recession that we are going to be living through right now in the second quarter of 2020 would be merely qualified as a technical recession. Because remember that in January and February, our numbers here were very sound, and we had a very, very sound banking system, and with a lot of cash in the banking system, which was not the case in 08 and 09, which is partly what led that recession to drag on. As a result, according to Goldman Sachs, their data is predicting that quarter three and quarter four would emerge as positive quarters. Now, again, every crisis is different, and a lot of this is yet to be determined because we don't know how long some of the social distancing and, working from home and not being able to fully be employed and some things like that are going to carry on. But if this is a short-lived technical recession, because of our strength going into this, it is predicted by both JP Morgan and Bank of America that we would have a short-lived decline and a short-lived technical recession. All right, so what is our path moving forward? Well, there is a path forward, folks. The old mantra, is buy low and sell high. Well, that's a lot easier said than done, and especially when emotion and timing issues can come into play. I've never been a big fan of trying to time the market. And I think most of my colleagues out here in our industry would agree with that. And actually, if you look at some data here by Putnam Investing, the data would back that up. By attempting to time the market by selling after a potential 30% loss, which is approximately where we are right now, you may miss out on the market's best days, which account for much of the market's gains. So if you look at this chart here, according to this period here from 12/31 of 04 to 12/31 of 19, during that time, if you stayed fully invested in the S&P 500, you were just invested in that index, all right, you would have incurred approximately about a 9% annual return during that entire time. But if you missed only the 10 best trading days during that time, you can see your return would have been only 4.13. If you missed 20 of the best trading days, it had been 11,908. If you'd have missed 30 of the best trading days, your return would have been a negative 1.35%. And if you would have missed the 40 best trading days, your return would have been a negative 3.51%. So you can see staying invested and not trying to time the market has by far been the best strategy over the long term based on this historical data. Now, again, I'm going to point out here, past performance does not guarantee of future results. And the best time to invest assumes shares are bought when market prices are low. You know, when during these times, I like to, instead of the mantra of buy low and sell high and trying to time the market, I like to follow the mantra, time in the market is more successful over the long term than trying to time the market. So I'm going to say that again. Time in the market has been more successful long term than trying to time the market. All right, so let's look at what has happened in the past. Well, folks, based on historical data, the markets will rebound. So if you look here at all of the events from 1970 through 2020, all right, and you can look at here the HIV/AIDS epidemic back in 1981, the plague there, the pneumonia plague in 74. Here was SARS in April of 2003, the Asian flu or the H5N1, dengue fever, the swine flu, the H1N1. We'll look at MERS here, Ebola, Zika virus, measles, Ebola, again here. You look at all of these times here throughout our history whenever we've had other epidemics and pandemics. You can see during those times that every one of the times the market has eventually rebounded. And I have some statistics here. According to the Dow Jones market data, the S&P 500 posted a gain of 14.59% after the first occurrence of SARS back in 2002 and 2003, based on the end-of-month performance for this index in April 2003. After 12 months after that point, the broad market benchmark was up 20.76%. And from the table, we can see that despite any poor performance that initially occurred following these outbreaks, stocks managed to experience gains within 1 year and often sooner. For example, the S&P 500 rose 11.66% in the roughly 6 months following reports of the 2006 avian flu virus. And that was a very fast-moving pathogen, also known as the H5N1. The market gained 18.36% in the following 12-month period. So again, it's too soon to call exactly what's going to happen and how the markets and the economy will react to this particular threat. But based on history, it does appear that the markets will be able to recover from this crisis that we are now in the middle of. All right, so again, some more data about this. You can see this table demonstrates that any poor performance that initially occurred following these outbreaks, we were able to experience that. Now, we are in a full-fledged bear market, which typically takes about 2 years to recover from. And so we will see. And I want you to remember, even if you think back to the 2008 and 2009 bear market, You know, within 2 years of the low in 2009, we did set all-time new record highs in the market. Again, I cannot sit here and claim that that is what's going to happen, but there is light at the end of the tunnel if you are a believer in some of the information that's happened in the past, and that we are still a fully engaged market. And the source for this data is the Dow Jones market data. All right. So as I begin to wrap this up today, what I'd like for you to really try to concentrate is to try to think long-term and stick with your plan. You know, again, the current driving fear is what is driving our market down. You know, this is 100% fear-based. There's so much uncertainty. Now, it is too soon to say how this will compare to the 2008-2009 financial crisis. But I really encourage you, try not to get caught up in the immediate situation and think long-term ahead instead. You know, this is the benefit of having a financial plan. This is why we do the planning with our clients, and why you have a plan in place to try to combat these type of situations. So how can we prepare for and weather the storm of COVID-19? Well, you know, I really encourage everyone to create a household plan of action. You know, in case of you do have the illness hit your household or disrupt your daily activities due to the COVID-19 in your community. You know, you might consider things such as having a 30-day supply of prescriptions or other over-the-counter medications, food and other essentials. You know, don't go out and hoard toilet paper. Don't go out and hoard anything. You know, if there's no hoarding, there'll be plenty to go around for everyone. You know, the other thing you might look into, know how to get food delivered if possible. Establish ways to communicate with each other. You know, we've been using these Zoom videos and utilizing social media, and it's a great way. You know, there's things such as Skype, there's Zoom, there's GoToWebinars, there is, you know, all your different apps that are on your phone, you know, things like that. You know, utilize that. You know, we don't, even though we have to social distance right now, we still don't have to be alone. And communicating is very, very important. And I especially encourage you to communicate with the elder folks out there. Also, you may want to establish some plans to telework or to be able to work from home. You need to think about, of course, what to do about childcare needs and how to adopt to the cancellation of events. We've all seen those. The other thing that I don't have on here, but I would encourage you to also to think about the elderly in your community. You know, they especially can't get out. If someone needs a meal, if someone needs their prescriptions delivered, you know, help them out. Do what you can. Speak with those folks. You know, don't let them be alone at home without even talking to them. You know, encourage them to reach out and to see if they need help. And then the last thing that I'll leave you with is to lean on the team here at Miller Financial Group whenever you have questions. Again, that's what we're here for. We'll all get through this together. But I wanted to bring this webinar to you to kind of give you an idea of where things are, how we're addressing things moving forward. And then, of course, if you need more information about what's going on, you know, with COVID-19, you know, go to the CDC website. I'd also encourage you to reach out to the WHO, the World Health Organization website. Also encourage you to reach out to your emergency management districts in your own area to answer any questions that you have. Again, with that, I want to thank you for watching this webinar here with me, this video with me today. And remember that we are here for you. Don't hesitate to reach out. God bless and stay safe.